We're going to look at capital budgeting decisions. And in this, we have to look at the net present value. That's something we're going to look at. And we're going to talk about the time value of money. $1 today is worth more than $1 tomorrow, because I can take that dollar you give me today, I can invest it. And if I can earn 8%, I can have $1.08 a year from now, as opposed to you giving me $1 a year from now. Or you could take some money and invest it, which would be less than $1, and earn interest on it and have $1. So it's kind of that time value of money, which for $1 doesn't really matter. But if we're talking about $20 million, then it can make a huge difference. So we're going to start out. There's a couple of things in this chapter. The payback period, which does not use the time value of money. Simple rate of return as well. And so I'm not going to really go over those. There's some good examples in the book, but I am going to talk about net present value and walk through a couple of these with you. And so let's say we've got two projects and we're trying to decide which one we want to invest in. So we have an invest in project A, and sometimes you'll be going up against someone and they'll be wanting to invest in on project A, and you'll be wanting to invest in project B. And so we're trying to show the relevant information and can incorporate the time value of money. So we have for either one of these, we have the purchase of the investment required, whether that might be a machine or whatever it might be. I'm not going to put the dollar amounts in there yet. And then we have annual cash inflows. And sometimes cash inflows can be savings, which is the same thing. We look at it the same way. And then we can have a single cash flow. And typically that'll be at the end of the life. So it's salvage value. So at the end of the life of the machine, we're going to sell it. And then we have to know the life of the project. So with this information, we can make a quantitative analysis on which machine to buy. So for this particular problem, that's not salvage value. So this is an investment where we can take $12,000 and invest it, and every year for 5 years for 6 years we get $5,000. Or we can take that same $12,000 and at the end of 6 years get $30,000, which I just told you $1 today is worth more than $1 tomorrow. But what about a little bit of that dollar spread out over 6 years? Which one is going to be a better investment for us? And so the first thing we're going to do is compute the net present value of project A. And we have to know the discount rate. In other words, what hurdle do we have? For this particular company, we're going to go with 18%. And we're going to have to use, now you can use a financial calculator, you can use Excel, you could download a calculator from the internet. I use the information given in the book, and I've got to find it, but there should be charts. I know when you do your Connect homework, you'll have the option to click on a chart, which will give you what we call the factors. Those are not percentages. Don't call them percentages. They're called factors, and I'm going to have to find them. So they're in your appendix, and I do not have my appendix, and so I had to go to a table, and I'm in the Accounting Tools website. This one actually doesn't go up to 18%, so I'm going to go find another one, but I did want you to see this. Accounting Tools, it's a very useful website. Okay, so I found, this is the present value of $1, so here's my 18%, and this 0.37, 6 periods. These are not years, they're periods, because it can be compounded semi-annually, and if it is, we have to multiply by 2. Quarterly, multiply by 4, but this one is compounded annually, so I'm going to go to 6 periods, 18%, and that 0.37 is the factor that I need to help me calculate the lump sum, and that would be this one. This is my lump sum. This one is an annuity. Oh wait, I'm going to have to change my formatting there. Hold on a second. This is an annuity. Which means we get it every year. And so I'm having all kinds of trouble here. There we go. Finally got it, and I don't want that to be a percentage. I need to just start over on that one. Okay, here we go. And so I'm going to have to go get my factor for an annuity. Okay, so I went and found a table, and I'm not sure you can see the top of this right now, but here's my 18% column. Here is my 6 period. So this 3.498 is what I need, and I'll explain this to you. Now, again, you can use a financial calculator. You can use Excel. I'm using the factors because that's the way they teach it in your book. And so what we're saying here, and I want to explain this a little, and a lot of you will already understand this, but if this is new to you, I want to explain it. What this is saying is the present value, in other words, what it's worth today, of $5,000 every year for 6 years, where I could earn 18%, is $17,490. And what we're saying here is this $30,000 that we're going to get in 3 years today is worth $11,100. And so what this means is if I took $11,100 and I invested it at 18%, in 6 years I would have $30,000. Okay? If I took $17,490, invested it today, and could earn 18%, I could draw $5,000 out each year for the next 6 years. And so when we do the net present value, we need this present value amount in order to do that. So a lot of people say, well, what's the present value of the investment? Well, that's today. We're investing $12,000 today, comparing apples to apples. If I invest $12,000 today, and present value of my return. So which one do you think is a better investment, or should they both be invested in? And you want to remember this is the present value of inflows. And so the net present value is going to be the net present value of the inflows minus the present value of the outflow. And we do the same thing here, the present value of the inflows minus the present value of the outflows. So this one actually has a negative net present value. So we actually would not want to make that investment. But this one has a positive net present value, and we would want to make that investment. And that's how we look at the net present value.